Imagine receiving your tax bill in the mail from the Inland Revenue Authority of Singapore. You live in one of the most financially efficient cities on earth. There is no capital gains tax, and dividends are completely tax-free. But as you look at your progressive income tax slip, you notice something painful. There is absolutely no personal income tax rebate this year. In previous years, the government handed out automatic rebates to cushion the middle class. But for the year of assessment 2026, that safety net is gone. Your tax bill has quietly crept up. You are left grinding out your salary, watching a huge chunk of your hard-earned dollars slide straight to the state. But why do some of your peers, earning the exact same six-figure salary, walk away paying almost nothing? The difference is not luck. It is tactical tax planning. Today, we are breaking down the exact, legal, dollar-for-dollar strategies you can use right now to slash your Singapore tax bill to the absolute minimum before the tax season closes. Let us start with the brackets, because you cannot reduce your tax until you understand how it is calculated. Singapore taxes resident individuals on a progressive scale that starts at 0% for the first $20,000 of your income and reaches a maximum of 24% for the highest earners. Every dollar you earn above 80,000 Singapore dollars pushes you into the double-digit brackets. Naturally, you want to claim as many reliefs as possible to bring your taxable income down. But here is the catch. The tax authority has set a hard, unbreakable ceiling on your personal tax savings. No matter how many reliefs you qualify for, your total personal income tax relief is capped at exactly 80,000 Singapore dollars per year of assessment. If you over-contribute, the excess is simply wasted and cannot be transferred to your spouse. To make things worse, some of the most popular tax hacks have been quietly discontinued for the year of assessment 2026. You can no longer claim course fees relief, which previously gave you up to $5,500 of deductions for professional upskilling. The foreign domestic worker levy relief has also been completely phased out. If you are still relying on old tax advice, you are leaving thousands of dollars on the table or setting yourself up for painful audits. Let us talk about the single most powerful tool in your tax-saving arsenal, the Supplementary Retirement Scheme, or SRS. This is a voluntary program designed to help you save for your future while reducing your taxable income dollar for dollar. If you are a Singapore citizen or permanent resident, you can contribute up to 15,300 Singapore dollars every year. If you are a foreigner, your cap is even higher, allowing you to top up to 35,700 Singapore dollars because you do not receive compulsory employer contributions to your Central Provident Fund. But here is the critical 2026 time-sensitive hack. Singapore's statutory retirement age is officially increasing from 63 to 64 on the 1st of July 2026. The age at which you can withdraw your SRS funds penalty-free is locked in based on the retirement age prevailing when you make your very first contribution. If you open an SRS account and deposit just one single dollar before the 30th of June 2026, you lock in the lower withdrawal age of 63 for the rest of your life, shielding yourself from future age hikes. When you eventually withdraw the money at retirement, only 50% of your withdrawals are taxable. Meaning, if you stagger your payouts over 10 years, you can withdraw $40,000 annually and pay exactly $0 in tax. The second strategy is the Central Provident Fund Cash Top-Up Scheme, known as the Retirement Sum Topping Up Scheme. You can claim up to 8,000 Singapore dollars in tax relief for topping up your own special or retirement account, and another 88,000 Singapore dollars for topping up your eligible loved ones' accounts. That is a potential $16,000 in annual deductions. But watch out for the 2026 tax trap. Starting from the 1st of January 2025, Any cash top-up that qualifies for the Matched Retirement Savings Scheme matching grant of up to $2,000 will no longer qualify for tax relief. The government is giving you free matching money, but they are taking away the tax write-off on that first $2,000, so you must plan your top-ups carefully. On a brighter note, the income threshold for a spouse or sibling to qualify for dependent top-up relief has been doubled from $4,000 to $8,000, meaning you have a wider net to claim deductions while supporting your family. If you have already maxed out your retirement top-ups and are still looking to lower your tax bracket, look at charitable giving. Singapore offers one of the most generous philanthropic tax frameworks on earth, giving you a massive 250% tax deduction for qualifying donations to registered institutions of a public character. If you donate 1,000 Singapore dollars to an approved local cause, the tax authority reduces your taxable income by $2,500. In the latest budget, this enhanced 250% deduction scheme has been officially extended for another 3 years, all the way until the 31st of December 2029. If you are a residential landlord in Singapore, stop wasting hours tracking every single maintenance invoice. The tax authority offers a simplified option where you can automatically claim 15% of your gross rental income as deemed expenses, no receipts required. On top of that 15%, you can still separately deduct the full amount of mortgage interest paid on your property loan. Just run the math. If your actual maintenance costs are low, the 15% flat rate can save you significant time and tax dollars. But if you underwent massive renovations, stick to claiming actual expenses and keep those receipts for at least 5 years. Tax planning is not something you do in October when the filing deadline has already passed. It is an active game of strategy that requires you to make your moves before the 31st of December of the preceding year. By taking action today, you keep more of your wealth in your own pocket, letting it compound in tax-free investment vehicles instead of handing it over to the state. If this video helped you navigate the complex Singapore tax maze, smash that subscribe button, hit the like button, and turn on notifications so you never miss another guide to building wealth.